All right, we are going to start whilst the data and data is fine now. Okay, all right. So we have a lot of this stuff. Is the font big enough? Is the font big enough or not? 1 minute. At the back, Shivam, you can see the font. Okay. So we will just have this. So these are some of the symbols that I put in for your next project as well. So we have this. So let's launch the option trader for crude oil. This is November 19. It's fine. Okay, this is okay. Both are fully visible. The borders are visible. Okay. All right. So we have some of this stuff. We can see the bid offer on the eyeballs. We have 42-day. Okay, guys, let's be quiet here. Okay. So we are looking at this. And where were we in terms of? So we covered in this. We looked at the option strategy matrix yesterday in the previous class, which is this is where we were, right? So we figured out how you're going to proceed. In the case of options, we have some peculiar idiosyncratic decision problems for option trading. So usually when we say for investment management, when we come to the buy sell decision problem, okay, we can relate it to the underlying asset. Okay, here if we have let's say I have, yeah, so this time I've loaded it and I'm not going to change the ticker because the network here may not allow. So I've got Microsoft here. Okay, you've got both the key factors in your, we are doing a quick recap. We've got both the key factors here in this chart. You can see the blue line, the mountain chart. This is called a mountainside plot. You know that, right? Okay, so the blue line is the blue area is the Microsoft stock price. Okay, and the red line is the ball at the eyeball. As you can see, as I told you in the previous session as well, you need to develop a feel for these eyeball charts. You will notice that the eyeball charts have quite a different characteristic from the underlying asset price chart. Have you noticed that? If you look at a very long-term eyeball chart, like this is from. We make this a little smaller. Okay, this is one of your tickers. I think you have. Do you have GDX as one of your tickers? I put in all these. I transferred all these copy of option tickers. So let me just rename this. Just yeah. So the GDX is one of your tickers, if you remember. The GDX is an ETF. It basically holds stocks of gold mining companies, okay, and some of those companies are also engage in copper mining, etc. Okay, but mainly focused on gold and silver mining. So this is your GDX, and the GVZ is the ticker that you can use. I've tried to put in the eyeball chart tickers because for me it's very important to have long-term data when you're forming views on markets. Okay, and the eyeball effectively can be treated also as a market, and you'll find that typically for eyeball you'll not have an opportunity. It's very hard to form eyeball views. Okay, what we've got here, no, this is actually like a finance chart. What we've got here, this is your GVZ. You'll have to use this. Where is the? Sorry, we are roaming around here looking for the chart. Yeah, this one. So this is your GVZ. This is corresponding to the GDX. Okay, this is the eyeball index for the GDX. All right, this is the eyeball index for the GDX, which is your GVZ. So notice that what I'm trying to show you is that this is a fairly long data series, almost about 10 years of data. So you'll notice about with eyeball charts that they tend to be one of the ways. Have you noticed that there is a difference between the the nature of the eyeball charts and the underlying charts? Have you noticed something about that? If you look at this chart also, if you look at, even if you look at the Microsoft stock price chart, and this here we have only about 2-3 years of data on eyeball. Okay, have you noticed that there's a difference between the nature of the two charts? Can you see that? The Microsoft stock chart, the underlying asset price chart, tends to trend quite strongly. Okay, whereas one of the things we say about eyeball is that eyeball tends to be vol in general. We talk about eyeball in general, both HVol, which you don't know yet what it is, but both HVol and vol in general tends to be more mean reverting. Can you understand the statement if we make this statement? Yes?
High variations.
Not high variations, more mean reverting, in the sense it tends to come back. Can you see that it's much more, if you wanted to look at these two charts, okay, we have the ideal cyclical movement as a, you remember your sine curve? You remember the sine curve plot, which is a nice harmonic, I mean beautiful symmetrical plot, goes up and down, it's the same, boundaries are the same. So if I were to ask you between these two charts, the eyeball chart and the stock price chart of Microsoft, which of these is more like a sine curve?
Eyeball.
It's the eyeball chart, right? So the sine curve is a classic example of a mean reverting chart, because it does not go, it stays within certain set bounds and it does not go out of range. It keeps oscillating within the same boundaries. Okay, so that's why you can say it's mean reverting, because you can see that it shot up here and then quickly came back. It doesn't stay up in a sustained manner like the stock price can. Okay, if you wanted to look at if you really want to look at what is meant by what is meant by a long term, here if you wanted to put the Microsoft chart here, all right, here if you see long term data for Microsoft, it's right, you can see how strong it is. Okay, so 136, this is of course, now you can see it here. Okay. So you can see how strongly this chart is trending. This is not so mean reverting, right? So this, of course, we have cherry picked a particular example. I'm just going to take a little less. This Yahoo Finance charts have become very problematic now in terms of display. Okay, but the point, you're getting the point, that in case of underlying asset price charts, so we're making a distinction between vol charts and underlying asset price charts, and we're taking Microsoft as an example. Okay, so what we're trying to show you is that if we have, maybe if I have this as a different kind of plot, maybe if I have a line plot, it'll make life a little easier for us. 136.28 still doesn't help us much. Yeah, but it is a little better. So you can see that when I'm looking at, I'm using Microsoft as a representative of the underlying asset price charts. Okay, all underlying asset price charts, and I'm using the eyeball for Microsoft as a representation of the eyeball in general. Okay, and you can see that the eyeball tends to be much more mean reverting, means in the sense that whenever it goes up, it tends to come down quite quickly.
So the variations are actually high, like it is not stable, so the variations are high.
You can say that, yeah. In fact, if you calculate the volatility, you may get a different kind of picture, but what I'm trying to show you here, we're not talking about the volatility. When you're talking about variation, you're talking about the volatility, right? In a way, you're right in the sense that when the stock price is shooting up like this, in this kind of a trend, if you notice, if you do a calculation of historical volatility as a standard deviation, it's actually quite low, because it's really kind of going up in a straight line. Okay, so in that sense, so we're not talking about that aspect of the movement right now. What we are talking about is the trending nature of the movement versus the mean reverting nature of the movement. Okay, so we are distinguishing. Mean reverting means it goes up and tends to come down quickly, so that it does not run away from the mean like this, like what say Microsoft has done here, right? Are you following? It tends to have pronounced trends, whereas a mean reverting chart will be very much closer to the sine curve kind of picture, where if it goes up and then again regularly tends to come down. Okay, so this is what we say about volatility. When you look at vol, try to develop a feel for the chart, you will see that it's much more kind of like squiggly, like a ECG kind of a chart, which tends to be much more mean reverting. So what we say is vol has a tendency to be mean reverting. So spikes in vol tend not to be very long lived, long lasting. Okay, whereas if you see this movement in the Microsoft stock price, it's going up and it's kind of just going up like that. Okay, so if you zoom out further, hopefully you'll get some, this 136.28 will not disappear. Okay, But anyway, so you can see this basically. So you can see that this is a very pronounced move in one direction. So in vol, what we are trying to say is just that it tends to be much more mean reverting. Is this clear? Okay. So just try to understand this point and try to develop a feel for these charts. Okay. So these things are very important. These are all very many insights which I can never really ask you an exam. That's why I'm not a big fan of exams and exam scores and all that, because a lot of the important pieces of learning, important elements of learning can't really be captured in an exam. I can't ask you like, is vol more mean reverting? That would be a kind of stupid question. Okay. But so everything that is of value that is taught in the class can't be really asked in a question, as a question. So if you have just an exam oriented approach to things, then you will not learn a lot of important things. So you need to develop a feel for this to understand that how IVOL charts move. Okay. So essentially what we do, what we have covered already, we are doing a quick recap. That is that we first look at, we form a view when it comes to the buy sell decision. We form a view on the underlying asset. Okay. On Microsoft, we take Microsoft as an example. Okay. And whether we are bullish on this underlying asset price or we are bearish on the underlying asset price. Okay. So we form that view first. Let's say I'm bullish on the underlying asset price. Okay. So that means that I have, again, Mehak, I have to cut marks for you. You're getting very distracted. Now that Kanika is not there, now you're communicating with Srishti. Don't get distracted. I don't want people to look at this and that. So Mehak will be a permanent member of the first bench from next time onwards. And we will have to separate you from your buddy. So Mehak has already got, she's scoring centuries in both innings now. She's got this one also. Okay, so what was I discussing? I also get distracted. Okay, so you first form a view on the underlying asset, right? And then you that's not sufficient, because if you have a, let's say we have a bullish view on the underlying asset, so then if I have a bullish view, this is why this decision rule is given to you. Okay, so right, so if you are bullish, you can be long what, short what, that we can figure out. Okay, we have the option position types. You come here and you look at if the directional view on okay, so this is yeah, we are here now. Okay, so we have option trading rule number 2. Okay, that we have, if directional view on the underlying market is bullish, this is you buy calls or you sell puts. Is that clear? Everyone is clear about that? Yes, yes, you don't seem convinced. You're clear. Okay. If you're so we are recapping a little bit. Maybe we are already overdoing it. Okay, buy calls or sell puts. Okay, and if your directional view is on the underlying market is bearish, you would buy puts or sell calls. Yeah.
Can you explain me with an example what is sell calls? Like with an example, how is it different from buy?
Buy call. Okay, so in this case, say for instance, we let's say we look at the let's take a look at the crude oil price. You notice something interesting about the crude. This is the big spike after the attack on the Saudi oil facility. Let's look at 6. You see how funny the market behavior is? If there is such a risk and the US is still not retaliated, that's all it went to. Okay, this is all it went to. This is why I keep telling you to follow markets, because all your analysis may be correct. At the end of the day, you can't fight against the market. You may have bought oil futures thinking that now the oil price is going to 100, but then if at some point of time, if the market keeps on dropping, and you see this is where the market was when the news hit, around $55. Now you see where the price is. Okay, so this is how funny the market is. This is what I mean by the fact that this market is not really rational. Okay, and you have really no way of figuring out how the market will react. If there's good news, will it react? You know, how well will it react? How positive will the reaction be? If there's bad news, how negative will the reaction be? So sometimes you'll find the market reacts positively to bad news also. Okay, sometimes it may not react to good news. So you have to figure out the market. You have to figure out your own way of navigating the market. That's what you need to evolve a style for. You need to evolve a strategy for dealing with the market, when any kind of market actually, not just equities, not just commodities, but currencies, interest rates, everything. Okay, because at the end of the day, in any finance role, you will eventually have to take a view on markets. Even as a salesman, when you're talking to customers, you need to have a way of intelligently talking about the market, discussing the market. Okay, so you can see this. Okay, so this reminds me when the first Gulf War happened. This is George H.W. Bush when Saddam Hussein invaded Kuwait. You know those stories?
Yes, sir.
Some of you know.
Yes, sir.
That basically the joke is that what does Saddam Hussein say when it gets very noisy? The answer is Kuwait, please. Because Saddam Hussein invaded Kuwait one fine day. He just invaded Kuwait. Okay, and the interesting thing was, I'll tell you the story from my own experience. So at that time, for some reason, that was a holiday. I was working on the Amex foreign exchange trading desk at that time. That was my first job. This must have happened in 1990 or 91. Okay, early 91 or late 90. So some reason there was a holiday in Bombay and I happened to be in the trading room because I wanted to follow international markets. So suddenly that news came across the Reuters wire and I saw the dollar jump, and this reminds me of that same reaction. Oil price also jumped and the gold price also jumped when Saddam invaded Kuwait. And then within the same day, this took a few days, this movement. Within the same day, by evening of the same day, all those moves had been reversed. So initially on that news, it jumped, oil prices jumped, gold prices jumped, the dollar jumped, and then by the evening of the same day, everything had been reversed. So this kind of reminds me of that kind of movement. So very often you'll find the market reacts in funny ways, and so there's no way to tell how far up this will go and how far down this will come, etc. So that's why it's so important to follow markets. That's why I give you these projects with real data, real-time data, not simulation. Okay, this is not a simulation. So real-time data, so you get a feel for how markets actually move, and then you also interpret the news flow. You have to see the news flow as well, right? That this kind of news is coming out and how the market is reacting, which basically tells you what we say in general terms in this kind of a situation. If you look at how the market is reacting if you look at the long-term picture of the market, of the oil market. Okay, we're coming to your question. Okay, coming to Sakshi's question. You see what the long-term picture on the oil market is. Now we're looking at about 5 years, 6 years of data. Okay, you see where the oil price is. Okay. So now it's come all the way down here. So this is considered to be in general. Okay, you can never have absolute rules in the market. This is one of the problems. This is why I say it's not like physics. But generally, this is considered to be a bearish sign. This is going to be taken as bearish price action because the fundamental picture is, at least from the geopolitical risk factor point of view, the fundamental picture is actually bullish because there's a high risk of supply disruptions. Okay, but in spite of that, the price is falling, which means the market obviously has a feel that there's a tremendous amount of supply and there's not enough demand. Okay, so this is something this is how you would look at when the market reacts in this way, in a bearish way to what the news that should be bullish. Okay, this means that there's a very bearish overhang in the market. This is generally how the market would see it. Okay, coming to Sakshi's point now. Suppose I feel that this is where the price is. Let's make this a little bit smaller now. I have this picture 75, 85. Okay, so suppose I'm bearish on the oil price. Okay, and I want to sell calls. What I would sell is basically, let's say the price is around 52.60. So I would first go. So remember, these are oil. So the most active for every market, you have to figure out what is the most active instrument. Remember, every market that we are looking at, typically we are looking at whenever you're looking at prices for any market, those are always, remember what I told you, this is again one of those things that can't be examined in an exam. But whenever you're looking at market prices anywhere, those are always prices for some instrument. Okay, like here the prices you see, these are futures prices. These are prices for futures contracts on oil. These are not spot oil prices. These are not forward oil prices. These are not option prices for oil. These are futures prices for oil. Okay, so you can see the November 19 is 64.65. You can see that December 19 is a little bit lower. Okay, so here we say this curve, we say the curve, and this, at least what we can see here, this is in backwardation. Okay, we learn these terms when we get into IFM and we look at the futures curve. Okay, so the point is these are futures prices. So now what I'm doing here, I have to see, so I'm looking at futures options prices. Okay, so let's say I have a bearish view on oil. Okay, I feel this is going to go through this level, 50 level as well. Okay, go towards 48, 44, etc. So if that's my view and I feel that that it's going to go straight away. Okay, so then let's say I'm willing to sell even a 55 call. So this is 52.65. This is the November contract. Okay, and this you have to find out where you look at the futures options, and you look at, make sure you know what is the underlying contract. When you're trading futures options, anytime when you're trading options, you have to be clear about what the underlying contract is. In a project like the one that you guys are doing this time, which is a project on US equity options, the underlying is very clear. It's common equities, okay, US common equities or US ETFs. Some of your underlyings are ETFs, like XLF is an ETF, financial sector ETF, GDX is an ETF, QQQ and SPY are ETFs. Okay, some of our ETF, but effectively they trade like common stocks. Okay, so these are spot equities. Spot equity for the contracts are your underlying in your project. Here we are looking at the underlying being futures. These are futures options. So the underlying is futures contracts, and you have to note with future, because futures contracts can trade for different maturities. Okay, so these decision problems you'll have even in trading futures. Which contract month should I trade? In India, you don't have that problem because you have only 1 month trading. Okay, this is why you should not study finance with an Indian market perspective, because you will not understand the true picture with respect to all of the major instruments, because the markets are not liquid. Here we see that the underlying futures contract is December. Okay, so luckily there's not much of a price difference. So let's say I'm willing to sell the 55 December call. Okay, you understand the view now? Okay, now I've not taken an IVOL view because it's kind of difficult to get. I don't know the ticker for the IVOL charts for crude oil. Okay, for crude oil options there should be a ticker which will give us IVOL charts. I can look for it here and see, but I don't have. If I just look, is there any crude oil vol index here? CBOE, Invesco, CISF, because I don't know the ticker. Volatility, S&P 500, CAC 40. CAC 40 is the French stock market. No, this is not working. So I don't know the ticker. I don't know. I'm sure there's a ticker, okay, for crude oil options. We're looking for, now I'm looking for the IVOL chart for crude oil options. Essentially, I'm looking for something like this. Just like you have an IVOL chart for options on Microsoft common stock. Okay, I was looking for an IVOL chart for crude oil futures. Okay, futures options on crude oil, but that I don't know the ticker, so I'm not able to find it out. Okay, so let's assume that I have looked at such an IVOL chart, because ideally what I have to, are you following the logic? Is everyone following what I'm saying? If you don't follow anything that I'm saying, you please let me know. Okay, because I can't look at everybody's face and be clear. Okay, all right. So so what I should do logically is I form a bearish view on the underlying asset. Okay, if I form a bearish view on the underlying asset, I know that there are two things I can do. I can sell calls or I can buy puts. Is that clear to everyone?
Yes.
Okay, I can buy puts or sell calls. Okay, now Sakshi wants an example of selling calls. How would I sell calls? Now typically, now we come to the second part of the decision. Okay, so if I have a bearish view on the underlying asset, I can either sell calls or I can buy puts. But which of those two should I do? Now that answer, is that clear? That's again a decision problem. I can either sell calls or I can buy puts. Okay, now I have to choose between those two. All right, so that second decision, for that you need to look at the IVOL chart. Okay, is this clear? That's why we look at the IVOL chart. So let's just pretend that we are looking at, this is the crude oil IVOL chart. Okay, let's just pretend, because I don't have the IVOL chart. Okay, so then let's say I form a view on this. When I look at this IVOL chart, and I form a view that even the IVOL is going to go lower. It's going to go lower to around 15% or so. Right now it seems to be around 25%, and even the crude oil IVOLs are going to drop. Okay, so now I go to my matrix here. Now I go to my decision matrix here, which I actually need to move all the way to the left, because this has a lot of other sheets which you guys are not going to be using in this course. So let me move all this stuff here. These are your option tickers. Okay, so I think we have only one to the. Okay, we'll see. Let's move to the. Didn't really move very well. I tried to move it, but it didn't move. So now I come back to my option trading matrix. This is clear? So I formed a bearish view on the underlying asset, so I can sell calls or buy puts. Then I come to the underlying option strategy matrix. Then I've also formed a bearish view on the eyeball. So now the decision problem I had between selling calls or buying puts, that I have solved because I have a bearish view on the eyeball, which means all option prices are likely to decline. Is that right? Is that okay? So all option prices are likely to decline, then therefore I would rather not buy puts. I would rather be selling calls, because that is consistent with both my directional view on the underlying asset as well as the directional view on the eyeball. Is everyone following the logic? We are actually just recapping what we did in the previous class. Okay, so we have spent the first half hour recapping, but I think even now some of you are not clear with the logic. Are you following the logic?
Yes, sir.
Okay, so I have decided now to sell call. Now I'll give her the example that she's looking for. So my view on eyeball is bearish, my view on the underlying asset is bearish, which puts me here. But you should understand the logic why it's there. Don't just memorize the matrix, okay? But you should understand why it is, because if your view on the eyeball is bearish, that means all option prices are likely to fall. Now based on your underlying asset bearish view, you had a choice between either buying a put or selling a call. Now that choice, that decision problem you solved by choosing to sell a call rather than buying a put, because the eyeball view is bearish. So the eyeball view comes in to solve that second problem. Is that clear? Okay, so now what I do is I go to my option trading, the option trader, and let's say I want to sell the 55 call, let's say. Okay, so I look at this and I maybe form an even shorter view with the 15. We can form a 60. We can look at a 60-minute chart. Okay, so I feel that, okay, this 55 level, this 55 is where the market was roughly when the Iranian, the Saudi oil strike news came and hit the market. So maybe this will become an important resistance level right now. The market won't go above this. So I decide to sell the 55 call. Okay, now this helps me to, when I'm answering her question, this takes me to the next two decision problems that we have in options. Because remember, our decision problems are still not over. Okay, so let's take this example. It's a good question that she's asked. That helps us to move us a little bit forward from what we covered in the previous class. Now, having solved the decision problem of what was the view on the underlying asset, it was bearish. Okay, so I could either sell puts, I could either buy puts or sell calls. And then which one would I do? I solved that problem by taking a view on the eyeball chart. That view is also bearish, so I decide not to buy the put because option prices are going to fall. I decide rather to sell the call. Now are my decision problems over? What other decision problem do I have left? Yes? Is my question clear? What other decision problem do I have left? Yes? How many lots? Okay, that's a different, yeah, we'll come to that. That's also a problem. But in this particular, that we already have as a separate problem. But in terms of buying and selling, we had one basic decision problem of buy, sell. Okay, that decision at that level, we have now in the case of options, you see that it can be split up into 4 different problems. In the case of when you're simply trading underlying assets which are not options, okay, like spot or spot, in the case of spot, which is the simplest kind of instrument to trade, you have only one decision to make. Okay, you have a bearish view on Microsoft common stock, so you sell it. If you have a bullish view on the Microsoft common stock, you buy it. That's the end of that buy sell decision problem, right? But in the case of options, just on the buy sell aspect itself, we have a lot of sub problems. One problem was, okay, fine, whether to buy or sell the underlying, whether your view on the underlying asset is bearish or bullish. That takes you to one level. You can either buy puts or sell calls. Then further you need to take a view on the eyeball. So that's the first level of additional complication in the case of option trading. Okay, but now my question is the option just at the buy sell? Your answer is not wrong. Number of units also has to be decided, but it's just not at the same level as the buy sell problem. We are right now just dilating on the buy sell problem. Okay, so yes, Shuchi, you had a point about this. Any other decision problem that we have to solve?
The strike price.
Correct. Expiry and strike. So she's given us both the answers. So we have 2 additional problems to decide. Okay, the strike price and the expiry. Okay, so the strike price decision. So you can see that if you want to sell crude oil options, we'll come to the expiry later. You can see there are so many strikes. So which strike should I sell? Okay, So that itself, there is a view to be taken there. Okay. So let's say I'll just quickly run through the to flesh out the fact that you have all these problems. Okay. So you have to decide the strike price, and in this case, what I have done is I've taken partly a view on the underlying asset. I looked at a particular level where the market was when this news came, and now it's dropped through that level. So I say it won't go above 55. Okay. So I take a view, a technical view on the underlying asset. I select a level, and I decide to sell the 55 calls. Okay. That's one way of solving the problem, 55 calls. But I also have to decide the expiry. Okay. So now typically here we have another rule that we have to look at. Now we'll introduce the other rule. Okay. Let's look at your session outline here. Okay. So we have the additional problems, okay, of so I'm referring to certain figures here. Please look at them. Now this is the 9th edition reference on the page number, so that may not match in your exactly in your 10th edition, but the figure numbers will match. So just 11.1 means chapter 11. So just look at the figures to get a feel for what the option sensitivities are. Okay. So now we have to look at okay, so we're going to discuss this a little bit here before we get into the Vega theta trade-off. Okay. Which expiry date to choose and which strike to choose. Okay, these are your additional decision problems. Okay, so you saw one way of choosing the strike. Okay, which is by taking a directional view on the underlying asset. Okay. Now as far as the expiry is concerned, I'll just briefly give you a quick summary answer to her question. Now typically what we want to do, we'll show you the reason for that later. Okay, is where the thumb rule is like this: when you're selling options, you want to be selling short dated options. Okay, and when you're buying options, you want to be buying longer dated options. Okay, this is the basic thumb rule. We'll explain the reason for that. Okay, so in this case what I'm going to do is I'm not going to sell a 42-day option. Okay, I'm going to rather be selling I'm going to just collapse this. What are the options we have? We have only 13 days, so I would rather be selling a 13-day option. Okay, so now first is I'm going to go down. So you see the first thing that I've done as far as the expiry question is concerned, we'll see the logic for this later on. Okay, it's based on the theta, because the theta is much higher for short dated options. You remember what the theta is? You forgot what theta is? Time. What time? What? Gil is speaking, so let's treasure this moment and let her make a contribution. Give her a mic. Give her a mic. She has finally become involved in the class. Yes.
So theta basically means expiration to time.
Expiration to time.
Expiration of time.
Yeah, that's correct, but that's not a good enough answer. Passage of time, what? Passage of time is happening all the time. Now also passage of time is happening. Garvit is looking at his watch and watching he's gone outside. So passage of time, that's not a good enough answer from a finance student. This is good enough for a layman, maybe somebody who's selling something somewhere, marketing guy. But theta's passage of time is not good enough. It's not a good enough answer from a finance student. You need to be more specific.
Theta is negative for short positions and
short position in what? Theta is negative. You mean it's unfavorable? That's what you mean, negative.
So it will decline now. The time.
What will decline? Time. Time will decline.
It would be negative.
No, but you're not able to express. I think maybe you know what your answer, but you're not able to answer. You're not expressing yourself properly. That's not good enough for a finance student. Anybody else wants to answer? Let's give it to Parul. What exactly is theta? We have already discussed it. You should be able to explain it clearly now. What exactly is theta?
The time.
Yeah.
Time to expiration.
Time to expiration is not theta. When you look at, if we go back to our option model, time to expiration is here. days to expiration, it's an input in the OVM. Time to expiration is an input. Yes, Rajan. Yes.
Sir, theta is the rate of decline in the value of the option with the passage of time.
Correct. So that is a much better answer. Okay, the theta shows you the rate of decline of the. Essentially, it shows you actually how much the option will lose value, how much value the option will lose. Okay, with each day of the that passes after the option is purchased. Okay, this is clear. Simple answer, but many of you were not able to get. Okay, many of you maybe didn't even know it, but both of you I think knew it, but you're not expressing it correctly. So Rajan's way of expressing it is much better, much more precise. It tells you what exactly. So theta is basically the rate at which, or it basically gives you a measure of the rate at which your option will lose value with each day that passes after you buy the option. Okay, so if nothing happens and only time keeps, everything sits still, all the interest rates and dividends and the stock price, the underlying price, everything sits still, like it's frozen in time, but time keeps passing every day, then your theta measures the rate at which your option is going to keep on losing value. So it's a wasting. That's one of the reasons we say that options are a wasting asset. This is clear? Have you understood this point? So first you have to understand what theta means. Okay, so we can already see that there are two people who have left the room at the same time. Both Garvit and Gulati have gone out together. So doorkeeper, you have failed in your duty. Doorkeeper is Aurora. That's a way of keeping him. That's a way of keeping him awake. Otherwise, he will fall asleep. He will also fall asleep. Okay.
So when
Yeah.
you're doing option sensitivity, so
Mike. Give her the mic. No, that's
I don't need
okay.
the mic.
Don't say she don't need it. She doesn't need it. Your English communication, I don't know if you are serious about getting jobs in the corporate world, but people will look at your spoken English and they will judge you. I don't care whether it's fair or unfair. It may be fair, unfair, unjust, but that's life. Okay, so you should be prepared. Take it to a level where it's not a problem, right? Okay, I hope you're not offended or demotivated. Yes, yes. No, I still see people coming and talking to other faculty in Hindi. Your Hindi doesn't need to be improved. Even people who have poor English are speaking in Hindi. So how is your English going to improve? Yeah.
Sir, so my question, not a question, but when we were doing option sensitivities, so we had written all these like delta, gamma.
You can see it there on the screen.
Right. So, sir, in the notes it was written that it is time to expiration, time decay. That's why we all have written this.
No, see, that's why I should not give you notes. That's why I should not give you notes. You should understand, it may have been written, I'll just see what it is. I'll just see what is in your notes, okay? That's why I don't want to give you notes. I would rather have you follow the video, make your own notes. Because in the video, I'll never say anything like this. I may have notes. What happens sometimes is, I copy from here, paste it from here.
You even said this in the class, that's why even I have written this and all this.
Oh, okay. So theta relates to time to expiration. That's not. That's why I should not give you notes. That's why I should not give you notes. I should not give you notes. 1 minute.
If we will not have this layout, then it will be difficult to understand the video.
Okay. How? Is it a little better now?
Yes.
Yes, sir.
Right? So that's why I don't want to give you notes, because you're just blindly memorizing from the notes, and I'm not getting views and I'm not becoming PewDiePie, and then Tarun will be held responsible. So that's going to become a problem. So I don't want to give you notes. I just want to give you the video, and then you can just watch the video and make your own notes. That's how it should be. Yeah.
So can you come down to 27 now? That's it. So you have also mentioned theta.
Yeah, see, has a short long position. Now you were saying negative, that's what I tried to find out. Negative means loses value from passage of time. Okay, so this also should have been mentioned, that a short, this is what you were trying to talk about essentially, that, but your answer was actually wrong. You said a short option position has negative theta. Actually, a short option position has positive theta, because these indications are shown. I really should cut out your notes. I should move into this and drastically edit out your notes, so that you are able to follow only the video.
I said that if we will not have this layout, we will not be able to
Okay,
follow
1 minute. Now 1 minute. But that's why you see, the mistake is all these confusions happen because you're not following the video and then reading the notes with the video and creating your own notes. You should first understand theta is time to expiration. Is that good enough for you? I mean, is that a good enough? If it's not clear, then you should understand. Force yourself to understand what exactly theta is. Here, this is a little bit more text on theta. This statement is correct. This statement, actually what that meant was theta pointing to time to expiration, was that theta relates to time to expiration. So theta relates to this input of time to expiration. Here what we are doing is, in this is just a shorthand way of writing. Now tomorrow if I ask you what is delta, you'll say underline, because the note it says the delta relates to underline. But you can't relate, 1 minute. So delta relates to underlying in the sense, so here what we are trying to do is we are trying to relate the option Greeks to the inputs in the OVM. In this particular segment of the note, what we are trying to do is relate the option Greeks to the inputs in the OVM. Underlying is an input, okay, vol is an input, okay, time to expiration is an input, and interest rate is an input. So here I was just trying to say that rho relates to the interest rate. Now if I ask you rho, don't say interest rate. Rho relates, this is the schema here, okay. So because I think I did not go in detail through the notes, I just pasted the notes in. I should probably just go in detail through the notes, okay. And here also all the references, you should read the references, okay. Refer to your, and you can also refer to this. I've given you a link also, you should read this link to understand what, if you had done all this, then you wouldn't have had this kind of confusion, that theta is time to expiration, okay. Alright, so where were we? Okay, here. So here, well, let me just show you one chart, then I'll paste that chart into your notes later on, okay. But let's look at something here. Yeah, so first you have to understand what theta is, okay. All right, let's make this a little smaller so that you can see the whole thing. All right, so why am I saying that? Why did you see me doing that when I was trying to answer Sakshi's question that I'll be selling a call? And why did I move away from the 42-day options? Because I have decided to be a seller of options, okay. So the rule is, when I'm selling options, I don't want to be selling such a long dated options. I want to be selling a short, this is the thumb rule. First we give you the thumb rule and then we give you the logic behind the thumb rule, okay. So as a seller of options, that's why I moved away from the earlier display which you saw was for the November-December, okay, the 42-day options. I don't want to be selling such a long dated option. I was looking for, preferably I would even have preferred to sell a 7-day option, but there is no 7-day option trading right now. The shortest we have is 13 days to expiry. So this is the shortest I can get. So that's why I came here. Now, why do we say that we want to be selling short dated options? Okay, and when buying, both of you had gone out at the same time, Gulati, and you went out after Garvit went. I don't know who went out first.
Sir, Garvit had gone out a long time ago.
Okay, Garvit has not come back. Okay, fine. Sit. So we'll have to penalize Garvit again. Why has he again disappeared? He just seems to disappear from time to time. So call him inside. Okay, so why do you disappear for such long periods of time? You're running some other business somewhere. Don't go out for such long periods of time. Everybody should be disciplined, because until you go out, nobody else can. Until you come back, no one else can go in. Okay. All right. So Aurora is a permanent doorkeeper. Okay, that's a way to keep you engaged in the class. Okay, so are you guys following the logic here? We as a rule we want to be selling short dated options. Okay, and obviously conversely we'll be buying long dated options, because we don't want to be caught buying short dated options. Why? Because because short dated options have very high theta. So first you have to understand what theta is. Theta is essentially, if you are long an option, that's working against you. Okay, if you are long an option, theta is working against you. Look at these sensitivities here. When you're looking at this, where is that option price here? You notice what the theta sign is? These are the sensitivities for long option positions. These sensitivities are for long option positions. Okay, so this, you can see what the sign of the theta is. Now we'll have to cut marks for Ganotra and Tarun also. Smiling, cracking jokes. Only I am allowed to crack jokes. You are not allowed to crack jokes. And my jokes, nobody smiles, so there's no risk. So Ganotra and Parul also will score some runs today. Not, sorry, Ganotra and Tarun. Okay. So 410. I forgot to write Mehak's name. These are all the stars. 1 minute, please come back quickly so that he can go. Okay. Yeah, Ganotra and Tarun. Okay. All right. So please don't. I don't want to catch anybody talking here, there, looking here, there. Please be. You have to be focused. Just looking at me. Okay. And which, all right, so which expiry date? Right now we are looking at expiry dates, and we have evolved this rule, which I will write down for you later. Not so much important to have the notes, rather we follow. So remember that these, so first you have to understand the rule as to why we want to be selling short dated options and buying longer dated options. This is basically related to theta, so you have to understand what theta is. Theta basically tells you the amount, it gives you the measure of how much the option will lose value. Okay, if there is a unit change in the time to expiration after you buy the option, and after you buy the option, time to expiration goes only one way, so the change means it's only going to reduce. Okay, so each day that passes after you buy the option, okay, if nothing else moves, what happens to the value of the option? How much does it fall by? That is captured by theta. So you notice that these are for long, these sensitivities are for long option positions, and you notice that both the puts and calls have negative theta. Can you see that? So negative, sometimes that's why I was pressing her on the word negative. Negative is still not good enough. I want to know that I'm going to lose money or I'm going to make money. I want it to be in that kind of term, saying that it's going to lose money. So a long option position has negative theta, whether it's a put or a call. Okay, which means every day you hold on to the option and nothing happens, the option loses value because of the theta. Okay, so the theta here is, what we are saying is short dated options have higher theta than long dated options. You can capture this here. Here what you have is this. Okay, so this is the chart that I want you to remember visually. Okay, this is the plot of theta against time to expiration. So what you do is you take a bunch of options, you take options and you change the time to expiration and you plot the theta, and you find that the theta, the theta increases rapidly. This is negative theta, so it's increasing. Okay, the axis, it's the magnitude is increasing, but on the negative side. Okay, is everyone following this chart? This is your typical XY axis chart. Okay, but except that we are plotting mainly the negative side of the x-axis, right? All right. Yeah, I always get confused between x-axis and y-axis. Anyway, so the vertical axis. Okay. So the vertical axis, we are plotting only the negative side. Okay. Right. So we see here in this plot, this is just a fact. Okay, if you do this exercise, you can create your own chart like this. If you do an exercise, you take that option pricing, option valuation model, and you keep changing the time to expiration, and you see what the value of the theta is. You'll see that the theta is very sharply negative for short dated options. Okay, and for longer dated option, the theta is not so sharply negative. It is still negative. But so the intuitive and understanding of this graph is that if you buy a longer dated option, okay, then for each day that passes with no movement at all, the loss in value of that option is much less compared to what would be happening in similar circumstances to a short dated option. Is this clear to everyone? Make sure you understand this clearly. Okay, so first you have to understand what theta is. Theta captures the loss of value of the option per unit reduction in the time to expiration. Okay, And so, and the other rule that we have is just based on a fact, okay, because of the way the OVM is structured, okay, that as the time to expiration keeps dropping, the theta really grows really big, okay. So for short dated options, the theta is much higher than it is for longer dated options, okay, the magnitude of theta, because still theta is always representing the loss in value for 1 day reduction in time to expiration, but the magnitude of that reduction will be much higher when you are plotting it for a short dated option. Is this clear? We can see one example here. We should understand this logic very clearly, okay, that let's say right now somebody note down the theta for the call option minus 0.05, okay. So let's make it really short. Let's cut it by, let us take it to 3, okay, 3 days to go. 30 days to go, it was minus 0.05. Now you see this, 3 days to go, the option price, it basically with 1 day further now, what did we say? 3 days, no, where did I, 3 days to go, yeah, okay. So you can see how theta has gone up very sharply. It is much more sharply negative, okay. The magnitude of the absolute value of that number is much higher, okay. So this is what is meant by short dated options having much higher theta than longer dated options. So that's why we have a further refinement of option trading. As Shuchi mentioned, there are 2 more problems we have to solve: expiration date and strike price. So I'm coming to the second of those 2 problems right now, which is the expiration date. I have decided to be a seller of options, okay, because of my view on IVOL. Now I come to the second rule, that if I want to, the subsequent rule, that if I want to be a seller of options, I should be pushing myself towards selling shorter dated options, because then I'll have higher theta. Do you understand the logic in this? You understand the motivation here? That you want to make money, obviously, right? So here what will happen is, as a seller of options, remember I'm a seller of options, okay. So if these sensitivities are for long option positions, now if I'm a seller of options, my position is short. Now what will happen to the sign of the theta for me? No, these sensitivities are plotted for, these are being shown for long option positions, implicit, okay. It's implicitly for long option position. Now if my option, well, I'm trying to sell calls, so when I do it, my option position will be short. So for me, what will be the sign of the theta? It will be positive, okay, because I've sold the option. Now what I really want to have ideally is, when, and this is also gives you the idea of what an option seller really wants, and an option, this will connect you later on to the idea of gamma as well, which we're not going to do in great detail. But ideally what I want as an option seller, ideally what I want is that generally without reference to the direction part, okay, if I'm selling both puts and calls, okay, if I'm just bearish on IVOL, what I really want is that things should just collapse, like everything should just go dead, okay. It's like the market is on holiday, so the spot doesn't move, nothing moves, okay, but time will always pass, nothing moves, but time will always pass. So essentially every day I'm picking up money, like here every day I'm picking up 16 cents, right? If I'm a seller of the option, this will just become a positive sign, but the magnitude will not change. So because the buyer of the option has negative theta, the seller of the option has a positive theta profile, okay. But similarly, the seller of the option has negative on all these others. Delta, gamma, vega is negative for him, okay. Rho is also negative for the call option seller, okay. So you can see this. So there's a flip side to it. There's a trade-off involved everywhere, okay. So is this clear to everybody that these are given? So theta is negative. These are shown for long option positions by default, okay. So therefore, if you're a seller of options, your theta is actually positive. So what you want as a seller of options is you want everything to go quiet after you sold the option, and so every day time will just pass and you'll keep on earning some money, because whatever you sold is going to keep on losing value, and that's what we want. Basically, whatever we have sold, that should keep on losing value. Whatever we bought, that should keep on increasing in value. Is this clear? The logic is very clear, okay. So basically, as option sellers, we want to see not a lot of movement after we sold the option. We want everything to basically just go dead, and so that we can keep enjoying the theta every day. We can keep eating the theta every day. Is this clear? Everyone is clear about this logic? Yes, Surabhi doesn't seem convinced. You're convinced? Okay. So now we understand so we have seen clearly firsthand that by playing with the OVM, we have seen that shorter dated options have much higher theta, which is what basically this plot is. Okay, we can just take this and put it into your notes. I'll write the part later on, but this is what you have. Okay, so you can see it here. This is basically visually, you remember this. Okay, that as you get to expiration, the graph drops very sharply, because as you get to shorter dated options, the theta increases quite sharply. So ideally you want to be selling a shorter dated option, and that will very quickly lose value. Okay, this is clear? Okay, so the other way to choose now, so the decision about the expiration date is clear to us now. We want to be selling shorter dated options, so by the reverse logic, we want to be buying longer dated options, because how will that help us? Remember, if I buy a longer dated option, we'll discuss this further when we get to the Vega theta trade-off. Okay, which is, if I buy a longer dated option, what is happening is that I have a lot more time, in the sense I'm not losing that much value every day. If there's no movement, I'm not losing that much value every day, because I really don't want to be buying a short dated option, because every day this dropping sharply in value, right? It's like basically, it's just like, you think of it, if you're buying a house with fully funded by debt, you would rather have a housing loan where the interest rate is lower than one which is higher, because if it's a higher interest rate, then every day you have to be earning more on rent, okay, to make up for that. So it's just it's kind of similar to that kind of logic. So you really want to buy a longer dated option. So one part is clear. So this is based on an understanding of theta. Okay, now we come to the second point, which is the second decision that has to be solved, which is the decision problem on which strike to choose. Okay, so one way I showed you, one way you can choose the strike is by reference to underlying views. Okay, the views on the underlying asset price, which is what we did was, in this case I took a view on the underlying asset price because I'm selling a call, and I looked at where the market was. Okay, when this news on the of the strike on the oil fields came, and I saw that the market has eventually moved back below that. So I'm saying that around 55, the market is unlikely to get above 55. Okay, and therefore I just select a point on the underlying asset price chart. I take a view, and I decide to sell the 55 calls. Okay, so that's one way of doing it, which is if we do it this way. Okay, which is, I'll just put it here, which is by so you understood this way of doing it. How do I choose the strike? I choose 55 because I think, because I'm selling a call. So understand this logic. This is it's a slightly inferior kind of logic, but even this you should understand. Okay, that why am I choosing 55? Because my view is, when I look at the underlying asset, because what am I selling? If I'm selling a 55 call, I'm giving somebody the right to buy oil at the November futures contract, or this is on the December contract, the December contract at 55. Okay, but my view based on the chart is that the December contract is very unlikely to ever go above 55. So if it never goes above 55, whoever has bought the 55 call, he'll never want to exercise it. Yes. Because as a seller of options, what do I want? I don't want the option to be exercised. Is that clear to everyone? Yes. The insurance company who is selling you car insurance, what they ideally want is that there should be no accidents, okay, and nobody will claim their car insurance. So that way they get to pocket the premium. All the premium goes in their pocket. They don't have to satisfy any claims. Is this clear? Remember, insurance companies are just sellers of options, so you can always keep this comparison between insurance and options. Okay, so the insurance company is selling options, okay, and therefore they are collecting the premium, because when you buy an option you have to pay the premium. So this price premium that you see here, the option price is referred to as the premium. Okay, so whenever you buy an option, you have to pay a premium. That premium goes straight into the pocket of the insurance company. Usually they are paid up front. Okay, sometimes you can arrange it in different ways, but most of the time we pay the premium up front. So ideally what the insurance company wants is no car accidents at all, so that nobody files a claim, and they don't have to pay out anything, so all the premium goes into their profit. okay, like at least a gross profit, okay, then they have to take care of expenses and stuff. But this is the logic, okay. So as an option seller, what I want is that whatever would cause the option to be exercised, here we can use this kind of general language to draw a parallel between car insurance and this kind of selling options on securities, okay. So when I'm selling options at 55 strike, what I want, why am I choosing the 55 strike? Because I think the market is unlikely to ever get above 55. So if I'm selling a 55 call and the market is unlikely to get above 55, whoever buys the 55 call will never want to exercise it, because why would he exercise an option to buy at 55 if the market is always going to be below 55? He would rather be buying at market. Is this clear? Are you following the logic?
Yes.
Okay, so as an option seller, this is one way I can choose the strike, which is I can choose with respect to forming a view on the underlying asset. This is clear? That I would sell the option which I think where the strike is such that based on the view of the underlying asset is unlikely to ever get exercised, and you should be able to see the parallel between that and say somebody selling insurance company selling fire insurance, because they don't want any fires, so they'll just collect the fire insurance premium and there will be no claims. Is this clear? Okay. So that's one way of choosing the strike price on the for the option that you're going to sell, okay, or the option you want to buy. The same logic will apply. Now there's another way of doing it, which is actually theoretically the more correct method, okay, which is by reference to eyeballs. This is one of the reasons why we use this kind of software, which is very sophisticated. You will not find this kind of display in most other pieces of software. I don't know if you guys are, any of you are using, those of you who are using Indian software, SMC and all, see if your option views, when you mouse over, do you get the bid offer spread on eyeballs? You don't have options access, okay. So anyway, the options you will find, of course, that the expiration dates are very limited. These are basically just front month expiration. Here you see many option maturities trading. In international markets, you will see many option maturities trading. In India, typically there'll be only like a 1 month or a 3 month kind of contract, okay, and just the front contract is trading, and the other contracts don't have liquidity. It's because the market is not liquid, okay. So in a proper market, you can see how many expirations exist. Can you see that just in the crude oil market? And they've given you the eyeballs for each of those, okay. Average eyeballs they have given for each of those, okay. Can you see that? So this is around 36% vol. Here you can see these are very long dated. You see how many days these are. These are, I think, 439, more than 1 year. These vols are quite low, but these are not actively traded also. That's the other problem, okay. That's one of the reasons maybe the vols are low, okay. So you can see this, you can see the number of options that trade. We are going to go back to our 13-day period because I want to be selling very short dated options, okay. So this is one of the reasons, as I said, we use this software, because in a good option trading software, you should be able to see this much detail. Can you see for the 55 call I wanted to sell? Can you see there's a difference in the bid offer eyeballs? First of all, the bid offer is 56.59, and you can see the eyeball also. What? You can't see the eyeball.
Yes, we can.
What is the eyeball? 35.47. Okay. So what did we see the other day when we looked at the understanding of eyeball, the intuitive understanding of eyeball? If the eyeball value is higher, the OVM output will be also, the price will be higher, right? So you can see, is that consistent here? Here the price is 56 and the eyeball is 35.47. Is it consistent with our view, with the logic? Yes or no? Is my question clear? I think many people have not understood my question also. What did we say here? We said that first of all, how did we define? Now don't look at the notes and figure out something in the notes and say what eyeball is. What did we say what eyeball is? Eyeball is basically the input into the vol, into the OVM. Anybody wants to mention or complete the answer? Eyeball is the input into the OVM. OVM is a model, so it has inputs and outputs, okay, and it has a mathematical relationship which you can't see now because this is a black box model. They have just shown it to you, okay. You understand what black box models are? This is another term that you should learn, black box models. because many of you are going to do stuff like machine learning and all. Like people were talking about data mining, and Anjum submitted a project report, it was project draft, where she had already given the conclusions of the project. It was just copied from the internet somewhere and just given the conclusion in the abstract itself, that the research shows that this doesn't work or whatever. So, but data mining, she wanted to do data mining, machine learning and all that. So one example is of neural network. Machine learning is a modern name for neural networks. So these are black box approaches. Black box approaches means it gives you an output, it tells you what to do. A black box trading system will tell you what to do, buy or sell, but you can't see the logic. Okay, why is the system telling me to buy? Why is the system telling me to sell? That you will not be able to see. Okay, so you don't get to see the structure of the model. Why have they come to see? Why are they recommending a buy? Why are they recommending a sell? So this is something that happens with these machine learning neural network systems, because the system learns on its own, but the system does not show you the reason for which it gives the output. Okay, so this is called a black box system, where you get an answer, you get a decision, you can buy, you can sell, okay, or you should buy or you should sell, but you never get to know the logic, the reasoning behind the system coming out with that kind of an answer. Okay, so many people are happy with black box system, that's fine, but if you're not happy, then that's not a right kind of approach for you. If you want to know the logic, then it's not the right kind of system. So you have to understand these terms. Okay, so we are using a term called black box system, so I'll just write it down as a thing. So these are black box systems. So this is effectively presented you black box decision models. Okay, we can just call it black box decision model, where you don't get to know the answer. Okay, you get to know the answer, but you don't get to know how the answer was arrived at. Okay, so unlike say if I give you a model as y is equal to a plus bx, and I tell you that value of x is so and so, value of a and b is so and so, therefore the value of y is so and so. Here you can see why I am predicting this value for y, because you can see the structure of the model. Okay, here, so this is not in a black box decision models, you will not be able to see the decision making logic. Okay, why it came out with that answer. Now what was I talking about? Okay, so this is effectively, in theory, of course, we know that the option trade, if you look at the formulation, it comes out of a partial differential equation. Okay, the option valuation model, the Black-Scholes model, etc., the Black-Scholes-Merton model. So the Black-Scholes option pricing model per se is not black box, but here it's presented to you like a black box model, because you can't see the working of it. Okay, you can't see the working, it's just telling you that if these are the inputs, then this will be the output. You don't see the structure of the model. It's not being shown to you here. Okay, but in fact there is a structure. So this is appearing like a black box model, because it's just giving you an output without showing you the reasoning behind that particular output. Okay, but so you can use this as an opportunity to learn this new term, which is black box models. Okay, so and so what was I saying? Yeah, so eyeballs. I was talking about eyeballs. So what is eyeball? Does anyone remember? The intuitive understanding of eyeball, or the mechanical intuitive understanding is that eyeball is just a measure of option prices, or index of option prices. So if the eyeball chart is rising, here if the eyeball chart is rising, means that option prices are becoming more expensive. When the eyeball chart is falling, okay, that means here like the eyeball chart is falling, option prices are losing value in general, both calls and puts. So that's the intuitive first level understanding of eyeball. Now the mechanical understanding of eyeball, what did we say? Do you remember?
Sir, eyeball affects the time value.
Yeah, okay, that's not incorrect. That's not incorrect. But mechanically, what did I say? What do we want to remember? Eyeball. These things you should remember, because once you do this and once you revise it, yes.
Cheapness and fairness.
Yeah, these are all just you're just taking out words from the notes. It's not wrong. Okay, it's reflecting the cheapness and dearness of options, because when eyeball goes up, the eyeball chart is going up, that means options are becoming more expensive. When the eyeball chart is dropping, that means options are becoming less expensive. Okay, so this is why maybe it's further cementing my decision to not give you the notes, because then you're not really learning it properly, you're just mechanically studying what is in the notes. So this has been clearly mentioned in your notes, that and we discussed it in detail also. We saw the example. So the eyeball is the vol input into the OVM, which produces an output which is equal to the market price. What is so complicated about this? Don't memorize it or write it, just understand conceptually. Once you understand conceptually, you'll never forget it. IVOL, the OVM is a fair value model. Okay, so it has nothing to do with the market. It per se has nothing to do with the market price. A fair value model, just like I was giving you an example of your senior who came up with a fair value of some stock at $14 or $17, and the stock is trading in the market at $414. So the fair value, because you arrived at it by projecting certain for the future earnings, etc. Okay, and therefore the fair value model output need not have anything to do with what's going on in the market, because the market is just adjusting to price, supply demand. There's more demand, price moves up; less demand, price goes down. Market is just absorbing and reflecting the supply demand pressures. Okay, whereas a fair value model, you're actually just taking a bunch of inputs which are subjective most of the time. Okay, and trying to project a fair value, calculate a fair value for so these two things need not be related per se. Okay, because the process by which you're arriving at them is quite different. Okay, but what you can do is you can look at a fair value model and try to say that if the market is using this fair value model, and if the market price is equal to the market's fair value model output, then what is because the only in the OVM, the only major confusion is with respect to the vol. This is a real major uncertainty. Nobody knows what the vol is actually going to be. Okay, so you came out with certain values for vol, and so we saw that suppose the option price was $3, so our vol input is 25. That's not good enough. How do I get to an option price of $3? Maybe if I put 50, what happens to the call option? Not good enough, so I have to make it maybe even higher, make it 70. So still I need to make it even higher. So you get the picture. I'll keep on increasing the vol input until I get a model output which is equal to the market price. So remember, a fair value model output and a market price, first you have to understand this clearly. These need not have anything to do with each other per se. Okay, they need not have anything to do with each other because they are arrived at by totally different processes. Market is just adjusting supply demand, people are buying, people are selling, and through that the market price is getting determined, okay, through the supply demand pressure. Whereas a fair value model is quite divorced from the market. It's just inputting certain subjective inputs mostly. Okay, all fair value models are not subjective. The arbitrage free valuation model will not be subjective, but this is a subjective model. Okay, where the inputs are subjective, you are inputting some figures and you are getting a model output. That need not have. Now if you wanted to match the two, if you wanted to match your model output to the market price, what would if you assume that the market is also valuing it at fair value, okay, then in that case what is the vol input that the market is using to arrive at this kind of a price for the option, which you assume is equal to the fair value. Okay, the market is assuming, you assume the market is using a fair value model. Okay, so in that case this 75 will obviously have to make it even bigger than that to get to 3 eventually, but you get the picture. So this part should be clear to everybody. We have already explained it before. Okay, so what does that mean? It means basically that and remember how IVOL is derived. IVOL is derived by looking at understand the process. Okay, you look at the market price. Okay, you look at the market price and you input that, you keep on and you take a OVM. Okay, and you keep on fiddling with the vol input into the OVM until it gives you an output which is equal to the market price. You keep on changing the vol input until you get a model output, because remember this model output need not have anything to do with the market price. See, remember these are market prices, these are tradable market prices. This 59.62, these are tradable market prices. Okay, how are these prices arrived at? People are buying, people are selling, there is buying pressure, selling pressure, and based on the current buying selling pressure, this is where the market is. Now if there's some massive buy order on the 55 calls, the price might shoot up to 65 cents. Okay, and if there is another massive buy order, then the price might shoot up to 75 cents. Okay, so this is how price is determined. Okay, now what is IVOL? IVOL is basically just assuming that if the price is equal to fair value, okay, if the price is equal to fair value all the time, then what vol input is the market using to arrive at that fair value, to basically arrive at that price equal to fair value. This is clear. You have to go back and think about it and understand it, maybe watch the video again and understand it. So the bottom line is that So we go back to the first intuitive understanding of options also. Okay, maybe I've made it more complicated, but it's very clear that you guys have not understood this mechanical point of I vol, which we have already covered. That's why you have to keep revising and understanding this. Okay. So the bottom line is that higher I vols means higher option prices. Okay, higher I vol means higher option prices. Okay, this you can see straight away from here. Everything here is the same. Everything here is the same except that this is the bid and this is the offer. So what do we know from market maker logic? The bid will be higher than the offer or lower than the offer? Yes? Is the bid going to be higher or lower than the offer in any market? Has to be always lower, because market makers will want to make the bid offer spread as a profit. So what do we see here? Everything about this option is the same, only that one, this is the bid and this is the offer. Expiration is same, strike is same, everything is the same. But this is 59 and this is 62. And what is the I vol for 62? 36.4. And what is the I vol for 35.4? So you can see that this one has higher I vol.
Yes.
So higher I vol means higher prices. This is what I'm trying to show. It's a simple point. We could have just used Parul's point that cheapness and dearness of options. Okay, but we have to go for, we should go through, it's good that we went through a long convoluted route, because we found out that people are still not clear about the mechanical understanding of I vol. Okay, you need to make sure these are all conceptual things. This is, if you lay your conceptual foundations properly, later on you can go into industry and study more detail. Techniques and all, I'm not worried. You can learn Monte Carlo simulation on your own. But conceptual clarity, and you will not find this kind of explanation in any of the books. So you have to understand it in the class so that it lays your theoretical foundation strong, in a strong manner. Right. So the other way, what were we trying to solve? What is the decision problem we were trying to solve? Which strike to choose? So one method you saw by reference to underlying asset price views. The second method is by I vol. We'll just call it by I vol. What is by I vol? We already know higher I vol means higher prices. So if I'm a buyer, do I want to buy more expensive or less expensive? I want to buy less expensive. And what is the index of the option prices? What do I look at to figure out whether option prices are more expensive or less expensive? I vol. Okay, so this is another counterintuitive thing that you're learning, which is that when you are trying to determine whether a certain option price is cheaper or more expensive, you don't look at this part. Oh, the 128 is more expensive than the 0.6. Okay, you don't look at it like this. These are the option premia. Okay, these are the option premia, 127, 132, 88, 92. These are option premia. Okay, is this clear? Pay attention, don't get restless just because we are approaching the end of the class. Okay, it doesn't matter. I'll just take one point and 2 minutes and clarify this important point. So very important rule. You do not determine which option is more expensive by looking at the absolute levels of the option premia, which is here. You can see this. These are the option premia. Everybody knows what option premia is? Option prices. You determine which option is more expensive by looking at the I vol associated with that option price. That's why this kind of software is important, because it tells you I'm a buyer, I'm a seller, so I'm only interested in the bids. I'm a seller of calls. Now which call shall I set? I've already set the expiration. Which strike call should I sell? So if I'm selling, I'm only looking at the bids. So I'm going to go through all the bids. It's 35.47, 34. So this is better for me. If I'm a seller, I want to sell higher or lower? Higher. So I'm going to go through this whole list of bids for different strikes and find me the highest I vol. 35.47 so far is the highest. 34, 34, 34, 35.345, 35.76. This is a little higher, but this becomes a in the money call. Okay, so I may have some reason not for selling it, for not selling it in the money call. Okay, so but you can also sell it, but the basic logic, if you forget about that. So I will hunt through this list and find myself so I can see those deep in the money calls actually have the highest I vol. So really I should be selling the 36, I should be selling the 50.5 call. Okay, this will have some other but at least let's get this logic very clear. How do I decide which strike to sell? The more intelligent method, actually, one is what I showed you, underlying asset price views. The more intelligent approach is to look at the eyeballs associated with the option prices. For that you need this kind of software. Okay, and then you sell. The basic logic is very simple. I will sell the option with the highest eyeball. This is clear? Please understand this. I will buy the option with the lowest eyeball. Yes? People have not understood. We'll continue this in the next class. Please go over and think about it. Watch at least the last part of the video. Watch at least that and understand this. Very important piece of learning. Option prices, whether it's more expensive or less expensive, you do not decide by looking at the absolute level of the option premium. You look at the eyeballs associated with those premium. That's why you need this kind of software. This is clear? You learned some important things today? Okay. So we have now solved 4 of our decision problems. Okay. Buy call, sell call, you decide. Buy call, buy put, sell call. Then whether to buy or to sell, you've decided. Now which expiry you've decided? By theta. And then by eyeball logic, you've decided which strike to choose. This is clear? So now you can start practicing. Your stuff starts from next week. I have still not received messages from all the groups. What is going to be, I better get it by this Saturday. Rajan has sent it. But you need to clarify which is for your... But which is the project trading? One sec. You mentioned it. Which is for project trading? Please check your emails, the ones that you have sent to me. You should have clearly indicated which ID is going to be used for your FDRM project. Is that clear? Please check it. Any technical question? No technical question. Lunchtime, no technical question.